I think it's more about, how close are we between late cycle and end of cycle, and are we kind of hitting a transition point or a tipping point? And it's ironic in a way, because in some respects it's almost like, we're flirting with a virtual recession. This notion that, soft data, survey data, confidence data is all softening to a point which kind of looks a little bit recessionary.
In the US?
No, not so much in the US, in the rest of the world.
US data, though, you're content that that's still very impressive?
I think even there, we see some deceleration going on. I think we think the best is past.
What does that mean for your sector sort of preferences in the US? Interesting to see consumer discretionary the worst performing for October, which not all people would have focused on, versus tech and industrials, for example.
Right. We're obviously more bond focused than equity focused, but what I would say is, you have not seen a year like 2018 since the global financial crisis or the stagflationary 70s, where pretty much every asset class underperformed cash. So we've been quite cautious. We're focused on, keeping duration short, focused on quality, and I would say that probably, would feed right into an equity market view.
In terms of the view in Europe, is that getting worse in a way that people perhaps haven't priced in yet?
Yeah, it feels a little bit more like Groundhog Day than Halloween. We're actually revisiting what happened earlier in the year when data kind of fell off a cliff in the Eurozone. So we've started to see negative data surprises coming in. It's almost like the rest of the world can't keep up with the US. We're seeing it in China, we're seeing it in Europe. Part of this is obviously driven by the problems happening in Italy, but it looks very generalized. And I presume it kind of relates to a slowdown in global trade. So again, at some level, it comes back to the whole US-China trade dispute.